Hey everyone, welcome back to Corporate Decoder, the place where we peel back the layers of corporate filings to reveal the real story. Today, we're diving into Nocera Incorporated's latest filing, and let's just say this one involves some interesting maneuvers with convertible notes and a dash of financial engineering. Before we get started, if you enjoy these unfiltered looks into company finances, please hit that subscribe button and the notification bell. Also, make sure to join our Discord community. The link is in the description below for even more in-depth discussions. So, what is the big deal here? Nocera Inc. has filed a Form 8K, which is basically a report for significant events that shareholders should know about. This particular filing is all about a new financial agreement that could have a pretty big impact. The main event is about a new financial agreement Nocera entered into. Remember that earlier report on the 3rd of November 2025? Well, this filing clarifies a crucial part of it. They have a deal with an investor, let's call them the note holder, for up to $300 million in senior secured convertible notes. And on the 3rd of November, they actually went ahead and finalized the first part of this deal. They issued an initial note worth $8 million, but they only received $7.28 million for it. That difference, almost $720,000, is essentially a discount paid up front to the investor. This tells us the investor isn't just handing over cash. They're negotiating terms that give them an immediate advantage or a better potential return. Now, here's where it gets really interesting. This note is convertible. That means the note holder can take this debt and turn it into shares of Nocera's common stock. The price they can convert at is designed to be very favorable to them. It is the lower of a fixed price of $2.01 or even better for them. The average closing price over 5 days or 93% of the lowest average price over 10 days. This structure heavily favors the note holder, as they're likely to convert when the stock price is low, giving them more shares for their money. On top of that, this convertible note carries an interest rate of 9% per year paid monthly. It is set to mature in November of 2027. But, and this is a big but, if Nocera defaults on any of the terms, that interest rate balloons to a whopping 18%. That is double the original rate and a clear signal of the increased risk if things go south. And to make sure the note holder gets paid, this debt is senior. That means if Nocera ever faces bankruptcy, this debt gets paid back before most other debts. Plus, it is secured by a first priority claim on pretty much all the company's assets that were bought with the money from this note. This is a strong move to protect the investor's money. There is a limit though to how much of the company the note holder can own through converting this note. They can't own more than 4.99% of the outstanding shares at any one time. This is a common feature designed to prevent an investor from taking over the company through a single convertible note, especially smaller companies. However, they can ask to increase this limit up to 9.99%. But any increase only kicks in 61 days after they notify the company. This whole deal is also happening outside of the regular public stock market registration process. They're relying on an exemption that basically says they're selling to a sophisticated investor who knows what they're doing and is likely an accredited investor. This means they don't have to go through all the usual time-consuming and expensive public offering procedures. Bringing us back to the signatories, the report is signed by Andy Ching and Jin, the Chief Executive Officer of Nocera Incorporated. Now, let's take a step back and look at the bigger picture here. Nocera Inc. is issuing convertible debt, which is a common financing tool, especially for companies that might have trouble getting traditional loans or want to raise capital quickly. The terms of this convertible note are extremely investor-friendly, with that low conversion price and the investor having significant collateral. This suggests that Nocera is likely in a position where they need capital quite urgently, and the investor has a lot of leverage to negotiate favorable terms. The immediate consequence of this is dilution. When the note holder converts their debt into shares, the total number of outstanding shares increases. If you own shares, your ownership percentage goes down, and the value of each existing share might decrease because the pie is now split into more pieces. This is often referred to as dilution, and it can be a significant concern for existing shareholders. The discount on the initial purchase and the low conversion price further amplify this potential dilution. Also, the fact that the debt is senior and secured is a red flag for existing creditors and shareholders. It means this new debt has preferential treatment, putting other stakeholders at higher risk if the company's financial situation deteriorates. The 18% default interest rate is a harsh penalty, almost a warning that Nocera really needs to stay on top of its obligations. On the flip side, this financing could provide Nocera with the necessary funds to pursue growth opportunities or weather financial storms. However, the aggressive terms indicate a strong need for capital. perhaps for operations or to avoid a more immediate financial crisis. We need to watch Nocera's use of these funds very closely. Are they investing in revenue generating activities and innovation, or are they just patching up existing holes? Looking at this report, Nocera Inc. seems to be navigating short term funding needs by making concessions to investors. The strength here is their ability to secure financing at all, but the weakness is the very high cost and significant dilution risk embedded in these terms. The opportunity is that this capital could fuel growth, but the risk is that it could lead to significant shareholder value erosion if not managed strategically. Ultimately, this filing paints a picture of a company prioritizing immediate liquidity over the long-term value of its existing shareholders, at least in the short term given these terms. It will be crucial to see how Nocera uses this capital and whether they can turn it into tangible growth that outweighs the dilution. Alright, that is our breakdown of Nocera Incorporated's latest filing. What is your take on these numbers and what they signal for the company's future? Do you think this financing is a smart move or a sign of trouble? Drop your thoughts in the comments below if this analysis was valuable. Hitting that like button really helps us out, and subscribe for more deep dives into the world of corporate finance. And don't forget to check out the Discord link in the description for more discussions and community insights. Thanks for watching, and we'll see you next time.